to make a follow-up video on the video I did yesterday about a business using their assets as collateral and then pulling that money out, buying a new asset to expand business. I think in the scenario I had $10,000-ish, and then we took out a loan for $2,500. But what is interesting about that is you can write off the $2,500 expense still, even though you took a loan, because it's two separate things. You have your asset, and then you have the thing you bought, and then you have the loan on the asset, not on the thing you bought. And so either you can add that new thing to your collateral, or you can just have it there for tax write-offs. And the debt that you hold, you can actually hold that debt indefinitely against the asset. And it sounds weird at first, but it's just an open line of credit against your asset, and you can always pull money against that or pay it off if you choose to. But the asset will appreciate faster than the debt, because the debt is always going to be cheaper than, let's say the S&P 500 could average 10%, and your debt's at 7.5. You're going to make more money all day long. It's cheaper to hold the debt. And then the question is, well, when does it get paid? Well, at the end of the life, when the asset passes to the next heir, the next owner in line, the asset gets passed down, the cost basis changes, and then they can now sell that without paying capital gains tax, pay off the debt, and restart. And so it's a legacy mindset. You have to think further out, but it's just a different way to run businesses, which is more long-term than just revenue-based and whatever I have now. You want to build your asset stockpile so it helps your business grow in multiple areas. And just thinking long-term, that's the key. We got to just keep thinking long-term and what's actually more beneficial, and just run the numbers yourself. Let's keep getting better. Y'all have a good day.